Well, the first law is pay yourself first. We went on this on a previous podcast, but the recommendation is 10 to 30%. That's what we look for. We want to be able to pay ourselves 10 to 30% every single time to pay yourself first. It's your money. You worked hard for it. You should be able to keep it. So too many people give it to everyone else. You give it to debtors, you give it to creditors. You never actually sit down and pay yourself first. And even if that's going to be storing it in your own capital system, like for us, we like to put it in whole life insurance. Why? Well, you'll find out more. But for other people, maybe it is a high yield savings account. I don't care. Just get used to paying yourself first, not the credit card company.
Amen. If you need to put it in a can, put it in a can, even though it's not growing. But at least you stop the system of being last in line for your money.
Welcome to another episode of WealthWise Banking. I'm Jeremy Lee Huggins here with my co-host, Jason Sipple. Jason, man, how's it going?
Going fantastic, man. We're excited down here in Ocoee, Florida. We've had a lot of wins with the boys. Diego's all clear for the Marines, which you've been a big part
Oh,
of that
when's he
journey.
shipping out?
In May. We don't have an exact date yet. In May, because the government is a little bit slow with stuff, believe it or not.
No, the government's never slow.
And then my man Connor Patrick hit his first round off backflip without any kind of spring material today, just on a mat, and crushed it and celebrated like a crazy man. It was super cool. So we're feeling super grateful today, my brother.
Good, man. That's awesome. I'm glad to hear it. I'm glad everyone's doing well. Looking forward to seeing those photos of Diego with his head shaved and becoming a jarhead. So,
Well, I've got lots of his head shaved. Yeah, back when I was racing, I would shave, and Patty made me get another set of shavers, believe it or not, because I would shave the pugs and I would take that shaver and I'd shave Diego. And she said, that's not right. And I'd shave my head, by the way, too, because when I was racing, I had no time to shower and comb my hair. So.
well, good. Well, I think everyone's tuning in to hear a little bit more about today's episode. So we've got an interesting title about what happens when your life changes. And this is something that Jason always hits me with. And it's like, what is the one guarantee in life, Jason? What do you always ask me? What is that one guarantee in life?
That is what I always ask you because it's true. Like, no matter what, the blessing or the blessing is coming and it's going to be change.
Yeah, change is always coming. And we're not talking about like change just like in the markets, right? We're talking about comprehensive change, like changing in your life. It's opportunities, it's emergencies, it's urgencies, it is life in and of itself. It's that constant that we always have. So we're going to talk about today whether or not you're prepared for change. That's really what we're getting into. And one of those things that helps us prepare for change is liquidity, right? It allows us to respond. It gives us breathing room. And there's a place that we like to hold a lot of that liquidity.
What's liquidity, man? What are you talking about?
Oh yeah, it was that little thing that you put into a glass. It comes out of the sink. Is that not it? No?
Yeah. No, I have a whole, this is a whole thing of liquidity right here.
That's a little bit of liquidity. Yeah, you
Okay.
have some of that. Yeah, so Jason, one of the things you're talking about there is, well, your income changes, right? Health changes, business cycles shift. If you're an entrepreneur, we go through different cycles. Kids grow up. We saw massive changes during COVID. The country doesn't even look the same way it does
Mm.
today versus when it was during COVID versus pre-COVID. So the real question is not whether or not your life is going to change. It's, are you going to be prepared, right? Are you going to be liquid? Are you going to have money that's there? That's what we kind of want to get into is what's your ability to respond to a lot of these changes in life?
It's a great question, and we've all seen it. Like you through them, right? I've went through them. Life is much different now, and when change happens, do you want to be reactive to it, or would you rather be ready?
Oh, I'd prefer to be ready. You just got me on this thought the other day. I saw a quote from Jeff Bezos. He talked about stress and what is stress? Stress is typically a result of not handling something that is inside of your control. So people get stressed about money because they're not handling something that they have control over. And if you believe that you don't have control over capital, this is not going to be the right podcast for you. I'm just going to go ahead and say, tune out now. This isn't for you. But for everyone else, if you do believe that you can control your destiny, if you can control your capital, then you are in the right space. And if you want to reduce that stress, this is how you gain a little bit of that control is by going through and keeping liquid pools of capital, being able to have that breathing room to be able to respond to these health changes, these income changes, these life events.
I'm going to share something with you and the listeners right now, Jeremy. I'm a little worried to share with you just because we learned that you don't even unplug when you're in Antigua, right? So like I'm worried to share this with you. But procrastination, I heard today, is the biggest form of self-loathing.
Mm.
Stings for all of us builders out there, doesn't it? But
Yeah.
it's also the truth, right? And all progress starts from when we start telling ourselves the truth. And Jeremy, we like to keep things simple. We like to follow laws. So let's start with what is the first law of wealth? And by the way, if you've heard this 100 times, it's okay. Hear it 200 times because eventually we're all going to start following it and things will change.
Yeah. Well, the first law is pay yourself first, right? We went on this on a previous podcast, but the recommendation is 10 to 30%. That's what we look for. We want to be able to pay ourselves 10 to 30% every single time to pay yourself first. It's your money. You worked hard for it. You should be able to keep it. So too many people give it to everyone else. You give it to debtors, you give it to creditors. You never actually sit down and pay yourself first. And even if that's going to be storing it in your own capital system, like for us, we like to put it in whole life insurance. Why? Well, you'll find out more. But for other people, maybe it is a high yield savings account. I don't care. Just get used to paying yourself first, not the credit card
Hey,
company.
amen. If you need to put it in a can, put it in a can, even though it's not growing. But at least you stop the system of being last in line for your money. That
Yeah,
is the message that Jeremy just said. Stop being last in line for your money. You deserve more. You worked hard to earn that money. Guess who should get paid first? You.
yeah. The What we're talking about is interrupting a money pattern, right? We're starting a new pattern
Yes.
where if all your money comes in, goes out just as fast as it comes in, stop, pause, pay yourself first, create some breathing room, and then go pay the debtors, the creditors. But make sure you're always paying yourself first. You're not going to be wealthy if you're giving your money away. All right. Let's just be honest about it.
For example, it's like Warren Buffett's quote, right? If poor would only do what rich people do, they wouldn't be poor no more. Well, guess what? The 1% in America since the 1914, I think, Jeremy, or 1919, they've been saving an average of 38% per year.
Mm.
We gave 10 to 30. Does it have to be 30? No, I talked to a guy saving 50. You decide, follow Parkinson's law, spend less than you make, right? But pay yourself first.
Well, let's give the flip side. The national savings rate in the country is under 4%. So for every dollar you make, think about that. For every dollar you make, the average person saves 4 pennies. That's terrible.
What is the Jeremy Luggins the Jeremy Lee Huggins savings amount?
For the longest time, before I got into real estate, it was actually 51%. That's what I was doing.
Whew.
I
How
was
about
looking at,
today?
yeah. Uh, it's a good question. I have not calculated that in quite some time. I started moving a lot of money into the walls of buildings. So I'm still paying myself first, but rather than into a savings account or high yield savings and stuff that I was doing before, now I'm moving it into investments. So it's just a different way of paying myself first.
And before you do that, though, it is being stored somewhere where you know that you're guaranteeing growth, right?
Well, I'm guaranteeing access as well, right? If you're getting into it, I always pay my policies and then I use my policies to actually fund my developments to my investments. That's what I'm doing.
And I just want to make the point, like you're using what I was told is an and both, right? It goes where it's guaranteed to grow, where it's liquid, where it's protected, where it's doing all these things, protecting your family, right? Protecting your loved ones, and then you're using it to put it in the walls.
Yep.
And now you're
Yeah.
making money or giving yourself an opportunity to make money in both hands.
Correct. Yeah, it's a both and strategy. You don't have to choose between paying yourself first and doing the investment. You can do both. Same thing with responding to emergencies. I've given examples before of paying down debts, my car, the AC units. Well, I paid myself first
Hmm.
before I paid for the AC unit, before I paid for the car repair, because I wanted to lock in that compounding. I wanted to lock in that growth. I also wanted to give my family protection. But when we start building this out for real life, right? Not perfect life, but real life, the everyday you and me life, people start asking, well, what happens if I commit to becoming my own banker, but then something changes?
I was going to get into what are some of the biggest fears that people have about this, right? And so, but real quick before I do that, I mean, as a family, we're saving currently as of last year, right? I went and calculated this, Jeremy, and looked how much we're putting into the policies. We're saving 31% per year right now of what
Mm.
we earn, right? And that's on, well, Patty and I both pay ourselves in the business, but that's on one business right now. So If you can find a way to do it and prioritize yourself, you can do that. I just want to give that example because if you haven't started doing it, just say, I haven't started doing it yet. No judgment, just start doing that. So let's jump into this first thing that the people have a fear of committing to a system, right? And then life's going to change. So let's kind of talk about why this system is designed specifically for that.
Yeah, well, I mean, probably one of the biggest concerns about getting into this and becoming your own banker and committing to paying yourself is, well, what if my income shifts, right? Like, what if I lose my job? Hey, I'm commission only. Maybe we have a down market and I'm not able to make as much commission next year. What if there's an issue with my business and we're kind of delayed, right? I need capital. Or to the earlier point, like an expense, some
Mm.
expense comes up, right? And those are fair questions. What's nice about the way that we design them is we don't design for a perfect life. We design for what we call meaningful and manageable. We design for real life. There's a manageable floor, right? Jason, you want to go into a manageable floor and explain what that means?
Ooh, I love me some manageable floors. So first we got the guarantee, right? Whole life is a guaranteed level premium. So I'm just going to use made up numbers, but say it's 1,000 a month, Jeremy. Okay, for easy
Mhm.
numbers. Well, that's right here. It's never going to go up. It doesn't matter if you get older, sick, or whatever, but your manageable floor is going to be a percentage. That is what's going towards your whole life. It's going to be a smaller percentage, and that can fluctuate, but it might be of the thousand, it might be $310 a month, or it might be $410 a month, or it could be other ranges as well. But just know that it's going to be significantly less than what the level premium or the guaranteed amount that you're committing to putting into this is.
Yeah. In my example, right, I like to call it an emergency number, where I'll say, hey, I'm going to do, again, $1,000 a month, but I can always drop down to, let's say, $400 a month, $500 a month.
Yeah.
And I don't have to worry about losing the policy. Well, guess what? You can actually drop down even below that. And the way that you do that is by, we call it a premium offset. You can just use a dividend to help cover that.
Mm.
So there are ways to drop the emergency number to an extreme emergency. Okay, there are ways of doing that.
Well, if you have cash value, you can go back to 1848, and people didn't have good money patterns then either, right? So whole life is there to protect the family in the case that someone that's important that is providing and protecting the family is no longer there. Well, in 1848, when that happened, like say in your example, it's $400 a month. Well, as long as they had at least $400 liquid, right? As far as cash value, they can take a loan and pay it as well, right? You can use that as well. So there's a lot of ways, again, flexibility is key, control is key. That's what we're looking to help people build.
Yeah. And so the next thing, so we talked about the manageable floor, the
Oh,
meaningful
I'll give
ceiling,
you. Yeah. What is the meaningful ceiling,
right?
Jeremy?
That's what's moving us towards our actual goal. That's the one that we want to focus on. We say, pay yourself first, pay yourself with interest, becoming your own banker, all of these things that help build a strong policy. We want to accelerate that growth. We want to really expand our options. And when I start going up to the meaningful ceiling, let's say that I fund up to the meaningful ceiling for 2 or 3 years. And then in year four, I have that downturn.
Hmm.
Well, to Jason's point, I can fall back to that manageable floor because I spent all that other time hitting the ceiling. I created that buffer. And the longer you hit that meaningful ceiling, the bigger the buffer becomes, the taller your home, right? We're talking about floors and ceilings, the higher the house, the financial house that you're building. So you have those two numbers. You have floors and you have ceilings. You have one that's the rock bottom. This is what I go to, but I still have control. I still have flexibility. I still have protection. And then I can go all the way up to the ceiling and start building towards cushion, peace of mind. I have optionality. I can respond to urgencies, emergencies, opportunities.
And I love how you just said another way to say what you're saying with the manageable floor is just think about that's the amount that has to stay in the policy. You can't borrow that money out the beginning, right? Like
Mhm.
that stays in there because that keeps your system going, your system alive. And when we go over these numbers, because this always comes up on all of our calls, doesn't it, Jeremy? It doesn't matter how much someone's making. We have a fear of the unknown. We have a fear of the future. Like, what if? What if this happens? What if that happens? It's like, okay, well, hey, this is built for the what ifs. Are you comfortable with 400 bucks a month or 500 bucks a month? Can you do something to earn that money, or would you have the liquidity you use to do that? So that's we want to make sure that we start helping you move past these objections, these thoughts, because in reality, Jeremy, they're not true because we're specially engineering it to make sure it fits your life.
Well, what's also cool is the more mature the policy, for every dollar you put into it, you'll actually get more than a dollar back in the cash value growth. So to your point, let's say that I have something that I've been funding for 5 years. I may put $400 in, but the increase in cash value that year might have been 525 bucks, right? So I gave them 400, they gave me 400 back plus another $125. I will go figure out how to get 400 so I can get 525. Now
And
take that on a bigger scale. I'm doing it on 1,000. Maybe I'm doing it on 10,000. I built a policy, Jason, I kid you not. They're putting in $15,000 a year. It's on a 1-year-old. When she is
wow.
65, her increase in cash value is a $500,000 a year. So think about that. She gave
Wow.
the insurance company 15,000. They turned around and gave her $500,000 back. I
That
will figure out how to find $15,000. Okay.
that's what I say. Hey, if you want to be, you want to think, we're teaching you to be a banker. We're teaching you to have control. I love this example because I use this one a lot. I've actually used it with practitioners, Jeremy, at the think tank. And I said to a guy, he's like, "What? Say that again." I was like, "Yeah, you just go to Jim and Susie sitting next to you, be like, hey, you want to give me a bridge loan? You want to give me a 20% loan? How about you both give me 7,500 bucks, right, Jeremy, for that 15 grand?
Mhm.
And I'll give you a 20% return." Guess what? Like the bank, I just made a huge return and they both got what they want. And I never used a dollar of my money, Jeremy.
Yeah. Well, that's a whole nother strategy out there that the wealthy use. It's called premium financing, where you can literally, quite literally, go grab a bank loan. They will fund the policy. They will earn cash value. They'll collateralize your death benefit, and you can use it for basically opportunities, business growth. That's a whole different strategy out there. That's more advanced stuff. I get the luxury of helping people at that high net worth. When I say high net worth, you don't premium finance $1,000 a month. I'll tell you that. Okay. This is where you start premium financing large sources of capital, and they're done for very specific reasons. But the banks love these policies. Why? Because they're guaranteed. The banks themselves, go look it up. It's called bank-owned life insurance. They own more life insurance than any other institution out there. So yes, you can do premium financing. There is a way to do it. Banks will lend on it. It's just for the average listener, for most of us that are on this podcast today, it doesn't apply, just quite frankly.
I appreciate you sharing that, just putting that little nugget in there. That's other stuff we can cover in the future. The premium financing deals I've seen were abysmal because they were done with that thing called something like an IUL, something like that. So Uh,
Yeah.
what you have multiple variables happening at once, the bank's interest rate fluctuating, the interest rate in the policy fluctuating, and that person I know, I mean, he has tens of millions of dollars of death benefit, but he's basically upside down almost $1 million in cash value.
Well,
So
that just goes back to how it's engineered and why you don't work with people who structure IULs. So
yeah, we
you
go
can
back
still, yeah, you can still build it out with an IBC practitioner. It just has to be built out correctly.
the correct way.
And you got to know the pros and cons of it. Like I said, it's not for most people.
Yeah. And so let's get back to like the family banking system we're talking about, right? We talked about a manageable floor, a meaningful ceiling. We're talking about control. So when we're talking about this properly structured dividend paying whole life policy with the three benefits working at the same time, right?
Hmm.
We're giving the money three jobs. One, it's liquid. It's accessible, meaning you can get it without jumping through hoops, begging the bank, filling out loan paperwork, waiting for underwriting, bending over and coughing, all the things. Like they're not looking at debt to income. It's just easy. They ask you two questions when you collateralize or borrow from your system. Would you like a check or do you want an EFT?
Electronic funds transfer for, yeah.
Yeah, that's you and I, let's hold each other accountable for that because I always said let's keep it simple like simple and not use jargon, right? So what's the second one, Jeremy? I went over liquidity. So what is the second one?
Control. So control will be the second one, right? You get to determine where the capital goes, how to actually use the capital. That's my biggest thing is If I want access to my money, I also want to dictate where my money goes and how do you use it. Well, I also look at these policy loans as a personal line of credit, meaning I'm going to be responsible. I'm going to repay my loans. But let's say that I miss a payment. Who am I accountable to? I'm accountable to myself. So if I used it, for instance, to go put into an investment, or I use it to finance a car, and I miss a payment or I miss two payments, I'm accountable to myself. There is no repossession. There's no foreclosure at the end of the day. So I want that control. So number one, it was liquidity. Number two is control.
Yep.
Number three, what's number three?
Number three is uninterrupted, tax-free compound growth or tax advantage compound growth. And I had a guy today, Jeremy, the light bulb went on, and how good does that feel? When someone is, Nelson said, hey, this is not taught, it's caught. But the guy's light bulb went on, and I was like, he's like, I'm ready, Jason. He's like, I just figured out from what you wrote back to me. He was a little stuck. It was one of those members that I'm getting like 10, 11 question emails. And
Mm.
it's all saying, I'm afraid, 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 right? And I answered the question, and well, not afraid. I just don't understand. I don't understand. That's a better way to put it. And he said, "Hey, I finally realized that when my money is growing and it's uninterrupted and compounding, when I borrow against it, it's still uninterrupted and compounding and still growing tax free."
Why is that? So let's pause right there for a moment. Let's explain why, because I think that's very important.
Sure. Well, no one that's listening in the car, right, can see my hands, but this is what I do all the time, Jeremy. I say, hey, this is your cash value. This is where you're capitalizing your system. You're putting money. You're making your deposits in your family bank system in this side, in this bucket. When you have a line of credit, like a HELOC, a personal line of credit, or any of those things like home equity line of credit or a personal line of credit, what you're doing is you're borrowing against this money, fancy words, collateralizing, borrowing against the money in my hand. So I get my one hand touching my other hand, and you're borrowing from the general fund of the insurance carrier. So that's how your money never gets interrupted. You never interrupt the money that's in that account because you're borrowing from the general fund of the insurance carrier.
Yeah. So the way that I like to look at it too, like let's say that you never repay that line of credit, that personal line of credit, the policy loan, what happens? Well, the reason you're able to access that cash value, I like to think of it as I'm really accessing my death benefit while I'm alive, more simply put. Because if I never put that money back in, well, they reduce my death benefit, my protection piece. So case in point, I got $1 million of death benefit. I've got $100,000 of cash value. I take $100,000 out for an investment opportunity. The next day I get hit by a bus. My death benefit is now 900 grand. Very simply put. So Jason's talking about the general fund. He's talking about the mechanics, but really that's what's going on. We're really, if you think of it more simply, I'm kind of accessing my death benefit while I'm alive. That's why my policy is allowed to keep funding because the insurance carrier was already planning to pay this out. They were going to pay it out in death benefit after I was gone. How can I maximize the living benefits today? Well, I
Yeah.
do it through the loan features.
Yeah. And case in point, just I love what you said, Jeremy. I love how simple you just made that. I always tell people though, because some people get confused, so that Jeremy didn't say if you have $1 million death benefit, you can borrow $1 million. He said that you can collateralize the cash value in your policy, and if something happens, like you can't pay it back, you die, graduate, whatever, then that comes out of the death benefit, and then the rest goes to the person that you made the beneficiary. So.
Yeah. Yours was more technically correct, but for the layman, I think it's an easier understanding.
Yeah, I had to make that clarity because I've had 5 or 6 calls in the last year where someone's like, yeah, I want $1 million policy because I want to start this business and I need to borrow $1 million. I'm like, okay, well, how much do you have liquid? Oh, I don't have any savings. I was like, whoa, hold on. We have a misunderstanding of what's happening here. So I just want to make that point of clarity as well. So
Yeah. Go get an SBA loan. The SBA will actually require you to go get a life insurance policy. When you get that life insurance policy, you're going to want to make sure it's structured for cash value. So that way it can actually promote the business and provide protection for the SBA loan itself.
oh, that is a perfect transition to, what is the difference, Jeremy, between a borrower and a builder, right? It's not income.
No, it's perception, right? It's the way that you work, the way that you think, the way that you interrupt the patterns, right? Those money patterns. A lot of borrowers out there is the vast majority of society. We're told to borrow. We're told to use debt. We're told to use credit. Builders, on the other hand, we go out and we create, we build, we multiply. That's what we want to do.
And that's what the folks listen to this. That's why you're listening, because you want to optimize how you can be a builder. And by the way, I was a borrower, and it wasn't that long ago. I was a borrower at 46 years old still. I was stuck in that pattern where I thought I could show up first, leave last, work hard, be humble, be polite, yes, sir, yes, ma'am, and it would all work out. And when you don't understand the game, when you're having someone else make a ton of profit off of you because of your patterns, and you start seeing that, and then you start asking different questions, then you can start moving towards being a builder. So that's for anyone who's listening who's like, yeah, I want to do this, but I don't feel like I'm quite ready yet, right? So
Well, you can keep telling yourself you're not ready and you'll forever never be ready.
true.
Or you can actually do the pattern interrupt. You can actually book the call, go to wealthwisebanking.com. We'll show you the path. We'll give you the blueprint. Like to Jason's point, he was a borrower. Guess what? So was I. So were most of us.
Yeah.
Then at some point, we basically said, enough's enough. I want control of my system
Yeah, we
because
had
no
enough
one cares
pain.
about my money. Yeah, no one cares about my money more than I care about it. Uh,
Amen. We had enough pain that we finally said, I need a better path. I need to put my ego aside, say, I don't know what I don't know, ask better questions, and book a call or ask somebody like Jeremy and myself, right? Like Jeremy said, go to WealthWise Banking, and I will ask you in the call, hey, Mike, hey, Joe, hey, Jason, hey, Jeremy. Do I have permission to be direct with you? And then I'll say, because after 4,000 plus conversations with all types of people, people with millions of dollars, tens of millions of dollars, and couldn't rub two nickels together, right? What I found is people don't have money problems, they have money patterns, and they're either moving us towards our goal or away from our goal. So I just want to be able to tell you the truth to help you get what you just told me you want as your outcome. And that's
and
what we'll do.
And to your point, you said literally people who don't have two nickels and people with millions. You can have millions of dollars and still be a borrower, right? Because most of those people are still living paycheck to paycheck. They may be high income earners, but they don't necessarily know how to control their capital. They don't know how to get that back in their lives. They just spend as fast as it comes in. So my doctors, my lawyers, my attorneys, I know plenty of them that are broke. When that pain is enough, that's when they typically book the call.
That's it. That's it. Just go to wealthwisebanking.com, book that complimentary strategy call. We'll meet you where you're at, both mentally, financially, and help you have a better path forward. So, Jeremy, we're already in banking.
You're just not the banker yet.
Be blessed. We'll see you in the next episode. Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.